Growth can be exhilarating, especially when it defies a cautious market. Robinsons Land Corporation entered 2026 not just with momentum, but with a seasoned readiness for shifting conditions. Revenues for the first quarter climbed 11% year-on-year, reaching over 12 billion pesos. Net income followed, up 9%. Yet for common shareholders, that momentum was more measured. Earnings per share crept up by only 2 centavos. This is a story of accelerating sales, but changing fundamentals. Recurring income, primarily from rentals, still anchors nearly half of the company's revenue stream, rising steadily to almost 6 billion pesos. What stands out is the surge in residential sales, up 40%, reinvigorating the company's development arm. Hotels and amusement income added to the advance, each posting double-digit growth as consumer activity continues its slow return to normal. But behind the resurgence lies a warning signal. The cost of real estate sales rose even faster than the revenues they generated, squeezing margins across the group. Operating income grew just 4%, and operating margins narrowed from 44% to 41%, a clear sign that higher sales didn't translate to proportional profit. While recurring businesses like malls and offices provided stable cash flow, the real relief came from financing. Lower interest expenses and a sharp rise in interest income helped offset the margin pressure, easing the company's financial strain and bolstering pre-tax profits. Robinsons Land's balance sheet tells a story of smart liquidity management. Cash reserves nearly doubled, thanks to both stronger operations and the strategic sale of shares in RL Commercial REIT, unlocking liquid capital for new projects and dividends. Yet this restructuring means a smaller share of profits for common shareholders, even as the consolidated numbers impress. The crucial question remains, is the residential rebound a true acceleration, or simply the delayed reflection of past sales? Inventory levels were steady, suggesting RLC is drawing down on existing projects rather than ramping up new ones. In sum, Robinsons Land has matched growth with prudence. Strong recurring income, improved liquidity, and disciplined balance sheet management keep it steady as the cycle turns. But investors should look to margin and shareholder earnings just as closely as revenue headlines. In a more complicated property market, resilience and measured strategy can prove more valuable than fleeting surges.